Hello and welcome to Market Outlook. This is Jeff Bish, president of MarketGauge.com, and I'm filling in for Keith this week. So this week was really all about a strong start in the first 2 days of the week, a pause for 2 days, and then a real beating on Friday. Net, we ended up on the week. But the real question I think to be looking at or asking next week is, do we break down from these levels? And if we do break down, will we continue? Or if we turn around and move higher, will we continue there? So the interesting thing to pay attention to here is that if we turn around and take a swing high in the Dow out, will we continue? Same would be true in the Qs, in the IWM. They're all sitting right at that 20 period moving average. We're going to look at the 10-day moving average data later. The thing that is a little disconcerting on the daily chart is they all broke above the 10, couldn't really hold it, couldn't continue, and then Friday brought them back down below. From a real motion standpoint, on the real motion charts here, there isn't a whole lot here that is bullish. If we turn around and move higher in the Qs, it will look bullish. If we can get back over these levels in real motion, that's going to look bullish in the Qs. But more or less, they don't look bullish. If we go to the weeklies, this is where it really gets interesting. All the same levels that I was just talking about apply. Difference is we're just talking about the high of the week in this case to watch out for, and the low of last week. Now, the reason that this is so interesting, and Keith brought this up last week as well, is that this is the 200-week moving average, the green line in each one of these charts. So IWM broke its 200-week moving average back in June, and we're right back to that level. So if we break this level, this is a really confirmed break below the 200-week. That is not what you want to see. If we go over here to the Qs, the swing low from earlier in the year, the June, is a little bit higher. So we're now below that as well. So if we break last week's low, we're breaking the swing low, we're breaking the 200-week, that's negative. Same thing is true on the SPYs. All right, we're below that swing low. If we break below last week's low, we're going to be breaking decisively below the 200-week. Not good. Same thing is true of the Dow. Right, so the question, as I said earlier, for the rest of this outlook is, if we break, is it going to be a head fake, or can we go lower? Well, from a real motion point of view, we are a little bit oversold on the weekly level. That doesn't mean we can't break to the downside. That, from my perspective, only means that if we start to rally, we might have legs if we continue to go. But remember, real rally, we have to get back over last week's high in order for me to be thinking that that might happen. There's not a lot that's bullish on these real motion charts here on the weekly basis. They're all negative, turning negative. Now, the one thing we don't see on this chart, and we're not huge on Fibonacci, but if you do the Fibonacci retracement from the lows of the pandemic to the high up here, and then you take the 50% line, it falls right under where we are. All right, so even if you're not a big Fibonacci person, which I'm not a huge Fibonacci expert, but 50% is a big number. We're sitting there right at the 200-day. Another reason to be focused on this level as being so pivotal. All right, so let's move into the internals. All right, oh, actually, sorry. Sectors. I want to jump to sector summary. The interesting thing about the sector summary here is everything got pretty beat up today. But as I was saying, if you look at the weekly, a lot of them were still up on the week. Now, a couple standouts here. Energy. XLE had an incredible week. OPEC Plus had a lot to do with that, cutting output production. And the other standout here is semiconductors. Semis really got smashed today on bad earnings, bad outlooks from the likes of AMD and others. So we want to keep an eye on semiconductors next week to see if that continues. We'll talk about that when we get into the modern family. The other thing I want to point out in this sector summary table is the real motion, the 1050 real motion, all pulled back into bearish. Now, the reason that I see this as significant is because this is telling me that the momentum in these names or in these groups, in a lot of these groups, may have looked like it was turning up last week, but or earlier in the week, but it's all back down into the bearish. And that, as we're going to see when we look at the 10-day moving average, is just a very bearish continuation pattern. So now let's take a look at the internals. The thing that I want to point out in the market internals is just kind of a general look fuzziness of pattern, which is we didn't really get totally oversold up here, but we did have a nice rally in all of these measures, and that is actually a problem. The problem is that now we've got plenty of room for this to fall, which means that if we break through the lows of last week, we're not going to be oversold, right? So that would be one argument from my perspective, that if we break the lows, we're not oversold. There's plenty of room for the thing to stretch down if we look at it from a market internals perspective, right? That's the New York. NASDAQ basically looks the same way, right? So nothing really concrete that really jumps out, but that general pattern doesn't bode well for a break lower next week. New lows, the things that stick out right now is we've got a swelling of the new lows today, which is not what you want to see. Now, it was a pretty big down day. That said, this is back over 300 new lows. That's really negative, right? What we want to look for next week is if we get down to these lows, do the new lows explode to new levels like they did here? That's bearish. Now, same thing with the NASDAQ. We got a spike up in new lows. So keep in mind, these are 52-week lows. So even though this didn't make a new 52-week low, the index, the underlying number of stocks did make large numbers of 52-week lows, right? It's one thing if you're making a new 52-week low in the index here that this would be swelling, but this is before we even get there. So keep an eye on this number. If we continue to move lower and that continues to swell, that's not good. What we want to see if it turns around is that this goes right back down. Now, the risk gauge is another thing that might be kind of a little counterintuitive. It's been neutral here. However, when I look at this, if we're in a bearish mode and then we go neutral, I look at that as kind of a bearish neutral, so to speak. So the fact that we're neutral here doesn't necessarily mean we would turn around. And in fact, if we look under the hood, one of the reasons we're neutral is because the high risk debt is outperforming the treasuries. That's not exactly a reason to be bullish in my point. So neutral, okay, but it's really neutral in a bearish trend. I would be cautious here. So let's take a look at sentiment. The ratio between short-term, long-term VIX is still negative. There's not much here to really harp on. I think the thing to pay attention to this week is VIX. This isn't new. This is all over the media in terms of the VIX seeming to be pretty subdued given how bearish the market seems to be. So if we do break out or break down to new lows, you're going to want to see this VIX breaking out to new highs in order for that to continue. If this doesn't break out to new highs and the market breaks down to new lows, I'd be a little suspect about the breakdown continuing. There's plenty of room left for the VIX to go before it gets to an extreme that would justify saying we're oversold here. So that I would say, kind of like the market internals, it's a bit negative that this is so low if we break to new highs, if that makes sense. If we were sitting up here at 22, 24, I'd be saying, well, we're elevated, we've been elevated. I think this thing might be a little overdone. That's not the case here. It's not the case with the Bollinger Bands either, right? So if you're bearish and you're betting for a break and a continuation, if it breaks, look for this thing to continue lower. If you're bullish and hoping that this thing isn't gonna snap, look for this to not make a new high if we make a new low. All right, number of stocks over or under the, over the 10-day moving average. So this is what I was referring to a little earlier when I said we're going to talk about this. So if this low here that we just had last week, which was oversold on this measure, this magenta level, if that low really popped, what we'd want to see and was going to continue, what we'd want to see is this number of stocks over the 10-day moving average explode higher, which it did, but then we want to see it stay there, right? Kind of like we did over here. You want to see it stay there. The fact that it popped and the markets went over their 10, consolidated, came right back down, this is what I'm referring to when I said earlier that, let me blow this up, that this is just not a good pattern for the bulls. This is a bearish, back over the 10 and ugly failure, kind of like we had right here, right? Kind of like we had right here, a little bit like we had right here, although this one looked like it could have had some legs. But the point is, if you get over that 10 and you don't continue, now you've sucked some people in, and it's like a roller coaster going down and starting from a higher point to crash through this level. So this is not what I would have liked to have seen. And the same thing is true down here in IWM. All right, now I think next week, probably, if this comes back down here, it might be a little too early to look for a turn up all at once. This is a slower moving indicator. All right, interest rates. There's an interesting situation in interest rates, anyway, from my perspective. Overall, the overall index didn't make a new low, but the thing that I want to point your attention to is the reason for that is that short-term rates. All right, so here corporates. Corporates did not make a new low. Short-term rates didn't make a new low. But when we look at the long-term TLTs, they did make a new low, right? They did make a new low. They held it today, but they did make a new low. So they basically performed worse than the short end. So that's not going to be good for equities for sure if that continues to slide next week. So if there's one thing to be watching out for on the interest rate front is if long-term rates again go higher, long-term bonds go lower, that is going to be a heavy weight on the stocks still, as it has been. So in terms of styling investing, I'm just going to go straight to the value and growth and state what is probably the obvious, but it's worth keeping tabs on, which is value continues to beat growth, which is basically at this point the equivalent of saying that running for safer havens here is what this is showing us, and that's what happened this week. Not surprising considering what the semiconductors did. Now, if we look at the modern family, there's two that I would pay attention to. One, I'm echoing what Mish has been saying, and that is IYT, right? And it's got that same pattern up and over the 10 and then right back down. One of the reasons to pay attention to this is well below that July low that it put in. And if anything, it rallied back up to it and now it's failing. Technically, this just looks terrible. And if IYT can't get going, then chances are the rest of the market isn't on a strong footing if it is going. If the market breaks down, let's look for IYT to be breaking down too. So if we scroll down to semis are the other one. So semis got absolutely smashed today, but they're still over their level. And for all intents and purposes, I'm going to say they're still holding their July level. So just like the market in general, if they don't break down below this level, maybe this is where it's going to bottom and turn higher. Still, I'll say the same thing. I'll believe it when we get over last week's high. If we break below this level, though, very bearish. Again, if the market breaks down, and the semis break down and IYT breaks down, expect it to continue to break down. All right. I know I could focus on IBB over here being one of the stronger ones, and from a triple play perspective, it looks pretty good here. Doesn't look good on volume, but if the market goes down, IBB is not going to save it. And even if the market goes up, IBB really isn't what you want to lead it. So yes, it's nice if you're looking for some trades to perhaps look at IBB, but if you're trying to figure out which way the market's going right now, I don't think IBB is going to be much of a help. All right, I'm going to say the same thing about KRE. Well, KRE is hanging in there, holding on the 10 with rates higher. That could be a reason for KRE and the banks to hold up. But at some point, the banks, in my opinion, are going to be threatened by the fear of a recession really hurting credit quality. May or may not happen, but again, KRE is not going to lead a move higher of any substance unless you've got IYT and SMH participating in it. So as strong as that is, great. Keep your eye on IYT and SMH if you're trying to figure out which way this inflection point is going to happen. There's times that you can focus on the other sectors and it'll be worth it. At this point, I wouldn't worry about it if you want the shortcut. In terms of growth versus EM, from my perspective, they're both doing the same thing, and that's all you need to know. They're negative. The interesting section here is, in my opinion, the ags and copper. Now, on a daily basis, I'll blow this up. On a daily basis, you can see that DBA here, the commodities, it's just consolidating. It can't seem to get back over this 50-day moving average. So why? I mean, is this a representation of the fact that maybe interest rates have finally gotten to a point where it's putting pressure on commodity prices? I'm not sure, but if this breaks down, that would be a really pivotal break to make. So pay attention to the direction that these commodities go, the softs go in either one of these directions, although this is going to have a hard time getting through the 200. If we get through the 200 and keep going, I'll be a little surprised, but at this point, nothing should surprise us. But that's what's going to happen for commodities to really press higher. Not saying that they can't. More interesting would be if they don't and they break lower. We've got inflation numbers coming out next week, which, well, let's just see which way these go. Copper, this is a little bit of a mess here until you look at the weekly. I think the weeklies on both of these are really what I would focus on, right? So the reason I'm saying this is the 50 week, right, which is now the equivalent of the 200 day I was just talking about. But to me, this is a lot clearer, right? It's broken down. It can't get itself going again. And if it starts to break down again, this is a very bearish pattern. That said, it hasn't broken down. And if it gets back over this level, it could be a pretty bullish pattern. So again, this is at a key inflection point. I wouldn't worry about what happens between 20 and 21. Those are the two levels to pay attention to. Now, copper over here is incredibly interesting because, again, this is the 200-week moving average. If the market breaks down and copper breaks down, those two things, in my view, go hand in hand. The market will be breaking down because it thinks the economy is going to have a hard landing or a harder landing, or things are getting worse economically. And copper breaking down would completely support that. Right, so if copper turns around and moves higher, that would be a huge move for 1 week. But if it moves higher, it's still stuck in the range. The thing to watch out for is a breakdown in copper would be very negative and would support a negative breakdown in the stocks. So gold and oil, also a pretty interesting week. And I'll get to the weekly in a second. So the dollar got hit a little in the beginning of the week, rallied towards the end of the week, probably interest rate driven, and both of those things are going to put some juice and some pressure into gold. So dollar rallied today, interest rates rallied today. That's going to put pressure on gold. Gold falls. The rally in gold the last 2 weeks has been pretty impressive. Stopped again at the 50-day moving average, where it stopped here as well. Real motion, it's been stopping there as well. As you can see, it's outperforming the SPYs here. The time that gold gets really interesting, in my opinion, is not so much just due to inflation. It's not so much just due to the currencies. It's not so much just due to the interest rates, even though I've just quoted all those things as being factors. The big picture, in my opinion, when gold is going to move higher in a big way is when something breaks in the financial system, or gold becomes viewed as the safest form of a currency. I don't think we're there yet, but there's a lot of talk about the system breaking. And with gold sitting at the 50-day moving average, a break over the 50-day moving average is probably something that's worth paying extra attention to. Again, I wouldn't be all that excited about it breaking over the 50-day moving average just on inflation news, but I would be excited about it if it seems like there's a break in the system. I can't tell you what that's going to be because it could come out of left field, like the whole debacle with the UK earlier this week. So that's how I would keep an eye on gold in the short term. Crude, you can see really strong move here. We did have OPEC plus news this week, so I would kind of put this into its let's see what happens next week category. But when we look at the weekly charts here, both of these are pretty interesting from a bullish point of view. Gold, interesting because we broke down through this level, and if we rally next week, not only will we be over the 50-day, but if we can get over this consolidation, that could represent a head fake of this breakdown, a head fake of a 200-week breakdown. So even if all gold did was rally up to its 200-day moving average up here, that's a pretty interesting pop. It's also oversold on real motion here. So a head fake back in the other direction and some kind of catalyst, as I was describing before, gold could really catch on fire in a way that we haven't seen in a long time. Now that's a stretch, because one of my inputs there is something breaks in the financial system, and that I can't predict. Crude oil, if we look at where this is rallying from, again, very interesting spot, right down to this 200-week moving average, and same idea. So it broke this pretty significant support level in here on a price level. It didn't follow through, came right back in a big way. Now, again, there was news that did that, so let's see if it follows through next week. If it follows through next week, that's going to be pretty convincing. This 80 level is really important, not that far away. If it breaks through that, now we've got a crude market that's hot again on a weekly chart. All right, so in short, let's take a look at the currencies. But to wrap it up, and it's actually a good way to wrap it up here with the dollar. In short, the trends here of rates going higher, stocks being under pressure, and the dollar going higher are all still intact. The question is, have we reached an inflection? TLTs at the low from the prior week, and the stocks at the 200-week level. The dollar not necessarily at a level that we can see here on the charts. Let's go to the weekly though. But the dollar, just more of the same. But the rise in the dollar, right, is one of the things that has people concerned about something breaking. And that, again, factors into a lot of what I've just said. So keep an eye on that inflection point. There's several things in this presentation that I've said to focus on if we break to the downside. Look for that for confirmation. Be flexible. CPI number coming out on Thursday could be the catalyst that sends this market in either direction. That's all for now. Trade carefully, make sure you manage your risk, and then let your winners take care of themselves. That's all for now.